Hi, everyone. Thanks very much for tuning in to our Thought Leadership webinar. Today, we're going to be speaking about the global economy after the coronavirus. We are very fortunate to have two highly distinguished panelists with us. We have Abby Joseph Cohen. Abby is an advisory director and senior investment strategist at Goldman Sachs, where she's been since 1990. You can read her credentials on our webpage. And I would like to highlight that Abby is an adjunct professor with us at Columbia Business School. And I have had the honor of co-teaching a course with her in macroeconomics during my time there over the past 5 years. Alexis Crow is joining us. Alexis leads the geopolitical investing practice at PwC and is also a frequent contributor to Bloomberg, Financial Times, Fortune, among many other outlets. Alexis also is a frequent guest lecturer in our MBA program, and she serves as a senior fellow at Columbia's Richmond Center. Myself, I'm Pierre Yared. I'm a professor here at the Business School, where I've been since 2007, and I'm also Vice Dean for Executive Education. Today, we were going to be discussing the long-term consequences of the current pandemic that we are living through. While a lot of the news cycle is focusing on immediate crisis management needs of our economy, what is true is that pandemics have historically entailed long-run consequences, and that is true of almost all pandemics that we have seen in history, from Roman times to the Black Death and beyond. Some of these consequences represent an acceleration of current macroeconomic trends, and others represent a complete regime change. While none of us obviously have a crystal ball, what we are going to be doing here today is having an open discussion about what are possible scenarios moving forward. I'm going to be focusing on three specific topics. We'll talk about what an economic recovery looks like and what are possible impediments to that recovery. We're going to focus on how the role of government has changed and may change in a permanent fashion as a consequence of this pandemic. And finally, we'll discuss the future of work, the company, and income inequality. At the end of our discussion, we're going to open it up for Q&A from the audience. So let's get right to it. Abby, I'm going to turn to you, and I'd love to ask you, can you tell us where we are right now in the macroeconomy and in financial markets, and what do you think recovery looks like?
Pierre, that should be a very simple question and straightforward answer. And to give you a very straightforward answer, the answer is no. We really don't know where we are in the economy. We have some sense of where we are in the markets because we, in fact, get prices on things, but we don't really have a good sense of where the economy is, in part because the frequency of data are not keeping up with what's happening in the economy overall. We have a better sense today than we did a couple of weeks ago because we have had some data releases, we've had some companies report first quarter earnings, but I think that many investors are basically saying we don't really yet know where we are, which of course makes it difficult to get a sense of where we are going. Let me give you some thoughts about where we think we are, and keep in mind that our sense of confidence in these numbers is dramatically lower than it ordinarily would be. We think that the second quarter of 2020 will be the single worst quarter for the U.S. economy. Parts of Asia had their single worst quarter in the first quarter of this year. But we think overall for the United States, GDP will be down about 6%. And that's just part of the story. The unemployment rate, we all know, will be incredibly high. Much of it will be concentrated in the second and third quarters because we think it will take some time before unemployment begins to recede. We also have to keep in mind that headline number on unemployment, the U2, U3 measure, tells only part of that story. U6, which is the broader measure of workers who are so discouraged they're not looking for jobs, And also people who are working part-time involuntarily, that number we believe is skyrocketing as well. We believe that that is already mid-teens and could be moving notably higher. The unemployment rate overall, that is the headline rate, could easily approach 10% over the next couple of months. This is a very difficult situation, obviously, for everyone in the economy. But I'll give you the general outline of expectations. This is not just a Goldman Sachs forecast, but the consensus forecast in the markets. And that is that once the second quarter is over, things will get better. They will get better slowly. The consensus seems to think that by the end of 2021, we will be back to where we were at the very beginning of 2020. So think of this as a 2-year recovery process. But there are plenty of things that could go wrong. And one of the things that we always hasten to add is we don't know what we don't know. This is called a novel virus because it's new. We still don't know exactly how this virus is transmitted. We still don't know the symptoms, and we certainly don't have effective treatments or vaccines at this point in time. Every day we're learning about new symptoms, we're learning about new population cohorts that are affected by it, including most recently children who are afflicted by a very severe inflammatory response to the virus. So we don't know what we don't know. I would add the following before I turn this over to the next question, and that's the following. I've had the honor of working with one of the main forecasting teams based here in New York that's looking at the public health data. They are among the teams that have been looking at the disease incidence, disease severity, the impact on hospital resources, and so on. So I've had a little bit of a peek under the hood. And what anybody who is a model builder knows, or economists who have used models, is much depends not just on the mechanism of the model, the equations that you've built, but the quality of the inputs. And right now, we are seeing a real shift in those inputs. And much of that has to do with the social distancing regimes that have been put in place and are now in the process of being lifted. And I'm not aware of any of these models that are not now at the point of saying, wait a second, we thought that we were going to be seeing a flattening of the curve nationwide, and now we don't think so. I also would hasten to add the following. Don't look at just the nationwide data. Look at the data excluding New York. New York has been such a large piece of this that the fact that in New York we are now seeing that flattening of the curve, this masks what's happening in other hotspots around the country. So in New York, fortunately, although we're still at high levels, each new day seems to bring a reduction in the number of new daily cases and deaths. That's relatively good news. It's still terrible news, but it's better than it was in New York. Other cities are not seeing that. And the other thing that we've begun to have evidence on is that non-urban areas are increasingly afflicted. These are areas where people thought perhaps that the virus would not find them. It has found them. And one of the things that we know about many of these communities is that they do not have robust healthcare systems. And so the incidence of disease is rising there. And unfortunately, the outcomes may not be particularly good because they don't have the ICUs and they don't have easy access for a whole variety of reasons to top quality healthcare. So it's one of the unknowns that is unknown, all right? We have in economics the unknowns we know about because this is a novel virus. These are the unknowns that are unknown to us at this point.
Thank you very much, Adi. I think you bring up a lot of very, very good points as well, in particular about the importance of data, not just modeling, but data when thinking about this and how unprecedented this is in terms of an economic shock for us to really wrap our heads around. Alexis, you've written and spoken about what an economic recovery looks like. A lot of your work also touches on not just what's going on in advanced economies, but in emerging markets. What's your view on the road ahead?
Thanks so much. It's an honor and privilege to be with you all, and hope you and your loved ones are safe and sound. Firstly, I'm in complete agreement with Abby that obviously much of this depends upon the epidemiology of what is happening with regard to the virus. And I think that's obviously creating many different ranges of forecasts, as the IMF put out 3 very drastically different scenarios for their world economic outlook. I agree on the unknown unknowns as well, the famous Donald Rumsfeld matrix. And there are certainly known unknowns. We don't know how many waves this will actually hit epicenters of economic growth around the world. My base case is for, in the alphabet soup of different alphabets, sort of letters that are being thrown around, is for a W-shaped recovery, where we're currently on the downside trajectory of the W due to the health crisis and economic stops and sudden shutdowns. That you do have nascent recovery in Q3, but that I believe some of the financial vulnerabilities may unavoidably shake out in the system in Q3, which would take us down further. And that's not exclusive to the US. I also have that outlook for the Eurozone and emerging markets. Firstly, just in terms of economic activity, where we were heading into the crisis was structural changes and secular changes in terms of what is driving economic growth around the world. So largely moving from manufacturing to services-based economies. So here in the US, services constitute 80% of employment. Leisure and hospitality and retail together constitute 20% of employment in the US. And so where we were was effectively manufacturing activity getting largely hit by the uncertainty surrounding the trade war, really mid-March 2018, throughout 2018 and 2019, hitting the jugular vein of economic growth for some major exporting economies such as Germany, Japan, South Korea, and leading to an uncertain outlook for many companies and investors around the world. Stocks carried on their different trajectory, which we can come to. But when manufacturing was held in a bit of suspension, you had services and consumption of services largely driving a lot of employment and wage gains around the world. The data shows this is not unique to the US and other advanced economies, that this is also the case in places like Brazil and across emerging Asia. So now what we have with coronavirus is a complete economic stop to the bulk of this services activity. And that's where I would say it's very harmful in terms of thinking about future economic growth in consumption, where many of the economies we look at around the world, including that of the United States, are driven 70% by consumption. So the hit to the real economy, I think, is very severe. In terms of financial stability and global financial stability, I would call out one key theme for us to note, which is the extent to which coronavirus might have compounded vulnerabilities that were already existing in the system and exacerbated these vulnerabilities to an extraordinary rate. The first would be the leveraged loan situation in CLOs in the US. In particular, the deterioration of credit quality, a decade of low interest rates, the halt to policy normalization, effectively halting an interest rate rise here in the US. And the relationship between passive investing and some of these leveraged loans. There's a question of whether or not the Fed standing in to be able to support this will hold stability in the system. I think not, but we can turn to that. The second would be Eurozone banks, and really also struggling with excess capacity, low return on equities, high amount of non-performing loans across the Eurozone. So some of the particular lenders have me very concerned at the moment, obviously, where you're likely to see non-performing loans increase dramatically as a result of the health crisis due to COVID-19. The third key risk on the dashboard of the global economy for me in terms of financial stability is leverage sitting on non-financial corporate balance sheets in emerging markets. So currently $31 trillion of debt sitting on non-financial corporate balance sheets. A bulk of the increase in that debt in recent years has been dollar denominated. So with a strengthening dollar, you may see significant distress. So I think you could see some of these shake out into the system. I would also just say, in terms of the local landscape in the US, when I look at some of the rent payment figures for the real estate sector, and you break it down by sector, I think you might start to see evictions, defaults, delinquencies shake out, particularly in some of the gateway cities where you've had significantly high rent. And I would see those as coming to the fore in Q2. So if we look at anything with regard to history, I would say that it's going to take probably 2 years for the stability to be realized, particularly with regard to the US economy. And my outlook would be slightly more dire at looking at 3 to 4 years with a return to robust profitability for some sectors. I think you will see hospitality lag for some time, even though it's definitely a driver of long-term growth.
Thanks very much. You both pointed to the fact that the rise in unemployment is dramatic, and in particular, it's dramatic in the services sector. I'm curious as to your thoughts as to how you see that reversing. The last 2 recessions that we've experienced involved the overall economy recovering faster than employment. And I'm wondering whether we should see that trend here in this current recession, or if you think employment will rebound much more rapidly, potentially because it's the decline in employment has been principally focused on services, and because it has been truly dramatic. I don't know who wants to take a first stab at that, Abby or Alexis.
I can start and basically say that I think that the improvement in employment will be both faster and slower than it was following the financial crisis. And the reason is as follows. I think that there could be a quick snapback in some categories. Some categories where the businesses are back and where they do not yet have an opportunity to figure out ways to reduce their dependency on labor, we're going to see an improvement. There are also a number of companies for which this is not relevant, and they will rehire workers. But it will take a very long time, I think, for a full employment situation to unfold in the United States. First of all, there are many companies and industries overall that were moving in the direction of reducing the number of workers per output, if you will. Now, if you're looking at it just as an economist, you say, oh, look at this, labor productivity is rising. But in many instances, it was a way to reduce the need of labor. The second concern I have is something that would be similar to what followed the financial crisis and Great Recession in 2008, 2009, and that is recent graduates, be they from high school, college, or graduate school. Many of them never really caught up with where they would have been. What we know, for example, is that first job, the experience from the first job and so on, is often an important leg up for many students. And what we basically have found is that many of the graduates from that period of time were basically, what do we say, underachieving what we might have expected. The terminology used by economists is that they were underemployed. Whatever their level of education was, many of them took on jobs that were somewhat beneath that level of education, hence the income levels were below what they might have expected. The other thing that I believe we should be talking about, and we'll probably spend more time on this later, is the geographical difference in terms of employment. Following the financial crisis, there was a real shift in where jobs were being created in the United States. Prior to the financial crisis, so much of those jobs were being created in small cities and in the suburbs of larger cities. After 2009, the lion's share of the job creation, something like 85%, happened in the major cities. We refer to them as the prime cities in the United States. This is where the job growth was, both at the high end of the scale of employment of income and at the lower end. And this is also where GDP was being created in the United States for a whole host of reasons that may now be accelerated because of the pandemic. We may in fact see the job creation may move back to some of the areas that have less density, and we may see stronger population growth there. We were beginning to see that over the last year or two before the pandemic, in which, because often the expense of running a business or renting an apartment in prime cities was so high, we did see some migration away from the main cities. This is something that may intensify following recovery from the pandemic.
Alexis?
Thank you. Yes, I would say that it is going to take a significant amount of time for employment to regain footing across the globe, but I'll focus on the US and the Eurozone. Here in the US, I think, we always tend to look back at the last crisis, and everyone keeps talking about the GFC, and everyone's been talking about the GFC for the last 12 years now, 11 years. I would say that the significant difference now is we're living currently in an economic crisis and a health crisis, not a financial crisis yet. And so when going back to the GFC, financial services, a conservative definition by the US government of financial services contribution to employment is only 5% of total employment in the US. So just looking again to retail, leisure, hospitality, that's 20%. So really, you're looking at a smaller employment share just in terms of sectoral growth. And if you look at wages over the longer term, also coming down in terms of financial services. What we have now in this economic crisis as well is a sudden stop to counter-cyclical economic activity. So typically, if you look at during some of the credit crises in the US, in the UK, in the Eurozone, there's something called the lipstick effect, where women will buy more lipstick because they're staying in, they're not going out, they're saving the expense, so they want to look nice at home. So the lipstick effect is gone in this crisis effectively because you're not going to wear lipstick under a mask, and many people are forgoing a lot of their personal grooming amidst the lockdown. So I think you will see significant struggles in the sectors where you've seen workers aggregate that have potentially been displaced at the blue collar end. I would say that the verdict is out on the labor market, the construction of the labor market in the US versus the Eurozone at the moment. So obviously we have greater flexibility in the US model in terms of workers, and many would say that that was why employment was able to spring back. One of the reasons why employment was able to spring back so rapidly after the great financial crisis, in contrast with the Eurozone. In the Eurozone, you have much stricter labor laws. Kurzarbeit, which is one policy in Germany that's being very effective at the moment at keeping workers in their jobs, being supported by the government. In France, you have chômage partiel, which is the same thing, where workers are effectively working less hours, but also supported by the government. This is actually one of the reasons why some companies, when they were hiring and doing sort of operations in the Eurozone, would prefer to go to Ireland or the UK because they had looser labor laws. So the verdict is out as to how this will play out in countries like France and Germany's favor, or in the US's favor, when workers can effectively go to another part of the economy to retrain and to be employed. So I would say that that's a key question going forward. I would also agree with Abby in terms of young people being unfortunately deleteriously impacted by this crisis. I think particularly those that haven't yet been able to get the certificates that they've been needing to get in terms of degree qualifications, I think will be very concerning. And another note just on what Abby was highlighting, that over the course of decades, companies in the US have been investing in total factor productivity, TFP, which effectively means investing in machines, which could reduce some tasks. And it's not more recent, it's long trajectory going back to the 1970s. What I do think you are seeing right now, and we're witnessing right now amidst Corona crisis, is companies realizing that they are far more efficient with less labor. So that is concerning as well, looking to potentially an increase in productive capacity and a decrease in the need for labor.
If I can add one more thing.
Sorry, go ahead.
Just to follow up that point, the single fastest growing employment category in the United States over the last decade has been healthcare, both at the high end in terms of physicians and biomedical researchers, but also in terms of those people who are now on the front lines, the nurses, aides, and all the other people who have been deemed essential workers who are at the lower end of the pay scale. This is where the fastest economic growth, fastest employment growth has been coming from. And one of the things we need to ask ourselves is, will this continue going forward? Will there also be, and it's an open-ended question, will there be a change in the way we structure the delivery of healthcare following the pandemic?
That's a very good observation. A major portion of the drop in GDP in the last quarter was in fact from the reduction in some of these medical services, interestingly. One thing that I did want to react to what Alexis suggested, which is, productivity growth is not such a bad thing, and it's possible that a silver lining here, if companies learn to operate more efficiently given the crisis, that could have positive long-run consequences for the economy. I don't know if you agree with that, but learning to work remotely, learning to be more efficient at managing data could be perceived as a silver lining here coming out of this.
I think it's blue collar, white collar.
Go ahead, Alexis.
I was just going to say, I think it's blue collar, white collar, unfortunately, because I think in terms of the white collar, it's the skills of agility, flexibility, creativity that can't be automated. And we're learning those at full speed. And I think at the blue collar end of the spectrum, when you're producing a service or a good that all of a sudden requires less labor, that you will see significant displacement. So obviously that has implications for skills retraining.
And I would strongly concur with Alexis on that and take it to the next step. One of the things that we had been seeing in the manufacturing sector of the United States pre-pandemic is that our manufacturing growth was actually quite robust. The United States remains a major manufacturing center, but we were doing it with fewer and fewer workers, and those workers were better trained. And I think one of the key elements in terms of whether we are successful as a nation going forward is whether the people who become increasingly displaced by technology are given other opportunities. For example, are they trained and retrained for the new positions which are available? Are community colleges sufficiently well funded to help people get this sort of training and so on? And the other thing that we've talked about before that's critical, and that is the geographic differences. We know, for example, that less urban areas don't have the same sort of healthcare systems. They also don't have broadband coverage to the same extent. I think everyone on this call, most everyone, has very good broadband access in major cities. It's typically 98 or 99% coverage. In less urban areas and rural areas, it's less than 60% coverage, which of course will affect not just job opportunity, but also educational opportunity. It's one of the things we need to think about in terms of the long-term recovery.
Do you think in general that, touching on your points about inequality in employment, do you think that we're likely to see an increase in the decades-long trends in inequality that we saw leading up to this? Or do you think there's going to be a bit of a reversal of those trends?
I fear that it's going to worsen. And when we think about inequality, I'm not thinking so much about the people at the very tippy top. Let's take a look at the rest of the spectrum. And I think that we may see increased pressure, at least on an inflation-adjusted basis, on wages in some of these other categories at the lower and the less skilled areas. and this is of concern. It has very significant political considerations. It has very significant social considerations as well. Pierre, you raised early on the idea that when you look at a pandemic, you shouldn't be thinking in terms of the next few months or quarters. Let's think in terms of decades. And if we go back to the great influenza of 1918, 1919, studies have shown that the communities that were most seriously afflicted by those pandemics, as measured by death or measured by any number of other consequences, not only did they have a hard time recovering economically, they also tended to move towards, in many cases, very significant radical politics. That's something where in this day and age, I think everyone is watching carefully in many different countries to see what does happen to the bifurcation of politics in terms of what happened and what do we do about fixing the problems that are facing any nation, both from a medical standpoint and also an economic standpoint.
Let's take that comment as a launching pad to move the discussion in two specific directions. We were receiving numerous questions on two specific topics, and we can address them in whichever order you prefer. One is, and it pertains to this issue of politics moving forward. One issue involves the trends in deglobalization that we have witnessed since the global financial crisis, and the extent to which those trends may be accelerated as a consequence of radicalization of politics in response and more inward-looking governments. I'd love to hear your comments on that. The second related point is we've seen a dramatic expansion of government across the globe in responding to the pandemic. Of course, these are arguably warranted given the state of emergency that we're in. There is a concern about how long do these interventions last, and does this set a precedent? What sort of precedent does this set moving forward? And when you address this, we're not only thinking about lockdown related policies, but more so also the dramatic fiscal and monetary interventions that we have seen. What are some of the long-term consequences in both? I realize this is a big umbrella of a topic, but I'm going to throw it out there and let you take it away. Alexis, do you want to talk about either of these points?
Sure. I will just opine a bit on income inequality because I think it's so significant and it's interlinked with the fiscal sustainability question as well as politics. I agree with Abby. I think it will become deeply exacerbated as a result of this crisis, and that's the tragedy of it. We have something called the savings glut of the rich in advanced economies. And in fact, an interesting paper just came out in March by some authors at Harvard and NBER on the ways in which the savings glut of the rich in the United States has not necessarily been correlated with investment, that it's in fact closely interrelated with holding the household debt of lower income households as an asset class. And so effectively enabling consumer debt. So we came into this crisis with the lower part of the income distribution heavily levered, $21 trillion of credit card debt, some households paying between 15 to 17% interest on those credit cards. If you look at a tepid inflationary environment, you have the two categories that are outliers in that, ties to what Abby was talking about in terms of healthcare. Those are the cost of healthcare and housing. So housing not only in the major gateway cities, but even to looking to some of the secondary cities like Nashville, becoming increasingly unaffordable for young people. So I think it will get exacerbated, and I think that's going to be a key issue in terms of leading to potential intransigence on the political spectrum. I find it's closely related to the question of fiscal sustainability, and as Pierre, you mentioned, this huge government fiscal bazookas in the German word response to the crisis. I think in many ways it's fight the crisis and the health crisis, do everything you can to preserve per capita in terms of headcount of people. And when the crisis falls silent, don't maintain the spigots open because of the severe repercussions. Here in the US, we have the exorbitant privilege of being the world's reserve currency, fiat currency. And so the 10-year is highly valued in terms of textbooks of asset allocation around the world as a safe haven. And so I don't see the risk of foreign dumping of US treasuries. Only 1/3 are owned abroad by foreign governments. Nor do I see the risk of potential run-up in inflation too much. We can come to that. I'm more concerned about the crowding out of investment spending in direly needed infrastructure. I think this healthcare crisis in America has revealed, obviously, a healthcare system which is ill-equipped to deal with a pandemic. I'm not going to talk about universal healthcare. That's another session. But also, as Abby was pointing out, the broadband, the social infrastructure, the fact that you have people now calling for broadband equity because some people in rural areas are needing to take their kids to a car park in a car to do their homeschooling because they're unable to access broadband at home. I'm hearing that about some of the college students in some of the colleges, even in New York. Also thinking about investments in education and learning for working. You know, here we are in this extremely prestigious University of Columbia and talking about MBAs for some of the jobs that are going to be in demand that have automation immunity going forward. You may need degree certificates that are not necessarily the types of degrees that we offer in terms of business school or different specializations. So I'll stop there.
Yeah, let me pick it up and talk about government policy per se. And that is, we have seen not just the fiscal policy stimulus, and I don't know that I want to call it stimulus as much as relief packages that have been of extremely large size. But we have also seen the Federal Reserve and several other central banks step in. And let's talk about that for a moment. The fiscal policy stimulus that we have seen thus far is roughly 9% or so of pre-pandemic GDP. And that's pretty consequential. It's much larger than we did after the GFC in 2008, 2009. And no less an expert than Ben Bernanke, who was an expert, of course, on the Great Depression of the 1930s and was Fed chairman and was very much involved in trying to get us out of that GFC. He has opined that it's good to go big at this point in time. If we learned anything 10 years ago, it was that you need to staunch the bleeding as quickly as possible. And that really was not done. The other thing that was, I believe, an error following the GFC and into the Great Recession is that the Congress, in its infinite wisdom, dramatically restricted fiscal spending by the federal government. And so there was actually a negative fiscal impulse from federal spending of about 1.5 percentage points of GDP during a 2 or 3 year period early in Mr. Obama's term of office. So while we recognize that this big bazooka probably will not be repeated in terms of the same size, we should be careful not to allow a dramatic restriction of fiscal policy anytime soon. And this is where I'm concerned about state and local governments. Most state and local governments in the United States cannot run a deficit. There are a couple who have a little bit of flexibility. They can run a 2-year budget rather than a 1-year budget. But as long as they're constrained by not being able to run a deficit, we may see, in fact, that state and local governments need to offset that fiscal stimulus from the federal government because they can't run the deficit. They will be firing workers. They will be reducing services and so on. So that's one thing to keep in mind. The other thing to keep in mind is what the Fed has done. The dramatic expansion of the Fed's balance sheet And the balance sheet in Europe and a few other places has really been quite substantial. And it's much more than interest rate policy. It's not just the cost of capital, it's the availability of capital that matters so much, number one. And number two, the Fed, by making the statements that they did, Mr. Powell issuing a statement basically saying we stand ready to do whatever we need to do, buying securities, not just the usual securities, not just the government issued securities, but saying they're willing to buy corporate debt as well. That's really, quite the statement. Because when we think about the shape of this recovery, I don't think either Alexis or I believe it's going to be a straight line. She described it earlier as a W. Here's my concern over the next couple of months, 3 months, 4 months. I'm not really sure how to time it. And that is, we will see, I believe, perhaps another wave of disease. That's not my area of expertise. But even without that, I believe we're going to see another wave of problem in the US economy, because companies that try to get up and running again, especially small businesses, may find that they're not able to do so. We will be seeing, I fear, defaults and bankruptcies. We have seen, for example, at the bank level, that revolvers, that is the so-called revolving lending agreements that banks have with their customers, many of their customers drew down those revolvers at the end of the quarter so their balance sheets would look better. But once they've drawn down those revolvers, and I understand they've done it at attractive interest rates and so on, they don't have as much leeway going forward. So I think when we talk about government policy on the fiscal side, it's not just federal, it's also state and local. And then on the monetary side, it's not just the interest rate policy, it's also what is the Fed buying into its own portfolio, and what are they doing in terms of relaxation of other measures. I want to make one other comment, and that is to say that we now know that we were lucky that the Fed imposed all of that tough love after the financial crisis. Some of the things that were put in place in terms of tougher stress tests, the things that were put in place by the Congress and so on, the higher reserve requirements and so on, what this has meant is that our financial system has been working. And we may not like various prices, et cetera, but it is working. And that truly is an enormous relief to many. And I think we should be pretty pleased about it. Over the next few months, what we need to see is the vibrancy of some of the smaller institutions. We know that the large banks are in good shape. We're not quite so sure about the small and mid-sized banks. Let's see what happens to them, particularly if their loan portfolios erode. And then, of course, there are those non-financial lenders who took on such a significant role over the last few years. One more data point, and then I'll stop. If you look at the S&P 500, energy companies are 3% or less of the capitalization weighting. But if you look at the debt markets, energy borrowers are about 15% of the total. And a lot of that money came from smaller lending institutions, including non-financial institutions. And that is, a potential source of concern going forward.
Abby, may I just ask a follow-up, and then I'll hand it over to Alexis. If you look at current equity valuations, and this is a question that has come in our Q&A there, do you think investors are being overly optimistic?
I will give you the combined knowledge and wisdom of my colleagues in Goldman Sachs Investment Research in markets all around the world. And that is, it depends upon the time frame. At current prices, and I haven't done the calculation today, so forgive me, but at roughly current prices, most of the developed markets seem overpriced on a short-term basis. If one looks out a year or two, by which I mean you're now you're discounting forward the earnings from 2021 and 2022 rather than 2020, things look sort of about where they should be. However, as we've discussed before, we have some peaks and valleys to get through in terms of the economic data and the earnings data before then. We also don't exactly know what the economy is going to look like at year end 2021. If I look at the valuation metrics right now, basically the United States and the European markets are trading at PEs that are consistent with ongoing long-term economic growth. It doesn't really incorporate some of the short-term and intermediate-term trouble. The valuation is even more fascinating in terms of non-Japan Asia, which is now increasingly dominated by China. Those PE ratios, just to use one metric, are running one standard deviation above historical average. Which is more notably above historical average than we see in developed markets like the United States and Europe.
Great. Alexis.
Yes, on this divergence of markets to the real economy, I mean, there's obviously Krugman's famous quote, the stock market is not the economy, the stock market is not the economy. And there've certainly been some macabre jokes about body bags in the US not being priced in. What I would say is that's not a new phenomenon, because I think there's a number of different factors. I just particularly thinking about US versus Eurozone leading up to the Corona crisis. In the US, even despite the 2017 tax reform, which was designed to, in theory, increase capital expenditure and gross fixed capital formation, i.e. companies investing in their skills, their technology, their people, we, in fact, had record share buybacks. So I think that's also leading to some of the froth in the system. Negative interest rates and the halt to policy normalization, I think, certainly led some Eurozone investors out of bonds, rotating out of bonds in the Eurozone across to US equities, also leading to an increase in valuation. But what I would say is what I watched were markets operating largely, I would say toward the end of 2019, in a separate reality than what was going on to the real economy from the trade war. And I think many were focused on the Fed stepping in to be able to do things like address dollar liquidity issues and to keep interest rates low. So I think going forward, you will see a stronger dollar start to hurt. 43% of the revenue of the S&P 500 is earned abroad. So I think that will certainly result in some significant pain. I would say also that, as Abby highlighted, there's
significant pain for U.S. companies, but it's possibly a good thing for some emerging markets, right?
I would say that's significant pain for U.S. markets, full stop, because you still see a demand shock. I mean, I don't think, even talking about, one key theme for investing is the Chinese consumer. You still had retail sales growing at double-digit growth throughout the trade war. I don't see the revenge buying bringing back the Chinese consumer in a significant way at the moment. So I just think you'll see a tepid demand even in pockets of emerging Asia. And then we have this other interesting phenomenon, which is that some companies are not offering their profit guidance, given the uncertainty surrounding the trade war. And so in the UK, you had the FCA actually step in and say, recommend to companies that had been hit by coronavirus to delay reporting. And here you're seeing the same thing in the US. And so I think, as Abby was highlighting, those pockets of data will lead to a lot of uncertainty in equities, I think, certainly probably over the next 2 quarters.
If I can address one other issue for the people who are very much involved in the investment world, and Alexis began to speak about this as well, the difference, as Krugman has pointed out, between the economy and the stock market. And that has become increasingly pronounced in recent years. And so, for example, so much of the US stock market is technology driven. Such a small portion of the employment market is technology driven, as one example. The other point having to do with share repurchases is really quite significant, but we also know that the impact on dividends may be there as well. So far, companies in the financial services community have indicated that they will not be repurchasing shares during this period of time. We're waiting to see what other companies announce really over the next few weeks in anticipation of their annual meetings. But this may say something more about rebuilding balance sheets than it says about reinvesting the money in their companies. One of the things that I have been concerned about for more than a decade has in fact been this use of corporate cash, not just after the 2017 tax cut, but really for the last 10 years. So much of that corporate cash going into share repurchase and dividends rather than into CapEx or M&A, which one could argue is a growth mechanism, or hiring new workers. And one of the things that we'll be watching carefully is if in fact we see a change in that trend once we get past these restrictions right now in this pandemic era, where companies are deciding to use their cash, they're shepherding their cash for other things.
Great. We have a number of questions from the audience, and before I turn to them, I would love to ask my final question, and we're going to open it up. Do you see any positive developments, long-term developments? Is there a silver lining here in the aftermath of this pandemic, something that may change all for the better? Or is it all doom and gloom?
I would just say that what I see is obviously leading up to this crisis was, I would say that ESG, impact investing, social responsibility was the biggest investment trend of our generation, and even looking into corporate strategy, where I think even probably Davos this year, I heard a beautiful quote, made converted people that were sort of dubious about climate change and the environment, and they became disciples. So I would say that in this whole realm of thinking about the wider stakeholder in terms of investing in corporate policy, that I have seen some promising signs in terms of the social aspects of this throughout the coronavirus. So particularly looking to some of the French companies standing in to protect their employees at no matter what cost, I think goes a long way to address critical shortages in PPE equipment. I've seen some very, very, I think, just reinforced ideas around social governance. And in many ways, I think that companies can report that differently. They're not necessarily doing so at the moment. At a moment in which the cost of capital for the environmental side and the climate change side may be slightly delayed. Now, of course, just looking at the economic output around the world, obviously we have a lot less pollution. So there is an offset there. I would say that you are seeing companies potentially focus on diversity more, because that's a low-cost way of meeting some of the ESG metrics. In fact, it's potentially a cost amplifier. I would also just call out something else that I'm seeing touches upon what Abby was sharing, is cash reserves and keeping cash reserves on hand, not even going into the financial engineering of share buybacks, but in Japan, 52% of non-financial corporations went into the corona crisis on the topics net cash. 33% of German companies on the docks went in net cash, non-financial corporates. So I think some will be looking to how are you creating cash reserves to be able to help support your employees if we do have future economic stops, whether or not that's from a next wave of coronavirus or whether or not that's from some other sort of economic stop, and a known unknown, potentially an Icelandic volcano or what have you. So I think that's going to be a question going forward, and that also may intend and imply different reporting requirements for companies and their shareholders.
It's interesting you mentioned the Icelandic volcano. I was trying to think about what sorts of tail risks are we not considering, and one thought that came to my mind was the year without a summer in 1816, which is, a tail event that we don't really think about. Abby.
Of course, if you look at European paintings from that period of time, Pierre, you in fact see some very strange use of color and the absence of blue skies. So thank you for pointing that out. I've been scratching my head, quite frankly, trying to think of potential silver linings for this situation. And I think I would be feeling better about it if not for the political discord that I'm seeing. I think people in this country were aware of the discord beforehand. We're certainly seeing more of it now. The other thing that troubles me is the reduction in U.S. leadership around the world. Normally, when there is a global crisis, the world's most important nation has stepped up in the past to help out. This has been true in health situations and other situations. And the United States, now being very inward-looking, has not been doing that. So I do worry about whether this is going to create a leadership vacuum. And of course, nature abhors a vacuum, so something would step in to fill it. I don't think we know yet how this turns out, but this to me could be the real black swan. The black swan being the pandemic we're all talking about. Well, there could be some other issues as well. One having to do with the cooperation within U.S. politics, another having to do with U.S. leadership around the world, economically, from a science standpoint, but also with regard to some of the ESG phenomena that Alexis addressed. So I think I still have a lot more head scratching to do before I come up with something that to me is a clear silver lining. Now, it could be, right? It depends upon leadership. There's the comment attributed to Rahm Emanuel, which is a crisis would be a terrible thing to waste. When there is a crisis, you can, in fact, with good leadership, rearrange things. And I think we're all waiting to see what leadership decides to do of a constructive nature.
Excellent. So I'm going to open it up to questions from the audience. We have way more questions than we're going to be able to get through. But there's a question from the audience about the total amount of debt in the U.S. And the fact that that inflation expectations are so low. If you look at market implied inflation expectations, they're low at 5-year horizon and beyond. Do you think that that's a correct assessment, or do you think that we're going to be in for a painful period in the aftermath of this, trying to resolve the growth in government debts, not only in the U.S. but in other advanced economies as well, and in particular in emerging markets that are not as able to withstand such a fiscal shock?
At this time, I would view inflation as a high-class problem. I think we should be more concerned at this point with disinflation. There's deflation in certain commodities, as we know, but disinflation does concern me until we see what the impact of all of this is, the rise in unemployment, what the impact will be on inflation-adjusted wages. If, in fact, the average worker finds themselves employed a few weeks or a few months from now, but perhaps at a lower average wage, that is something that would be disturbing to me. Longer term, I do think that there should be this focus on what will all of this debt do to cost of capital, what will it mean in terms of inflation, and so on. I think that is not something we need to worry about quite yet. We will have our chance. one other point is, as the Treasury finds itself in the capital markets now borrowing, I wish they borrow long. I wish they take advantage of these very low interest rates that are available, take advantage, as Alexis mentioned before, that we are the world's reserve currency. There are lots of buyers out there for our debt at all maturities, and I wish they would extend the duration of their own portfolio of borrowings.
Well, just to comment on that, one interesting thing is that, Federal reserves of the Fed are essentially short-term government debt also, and the explosion of that also essentially means that the government is borrowing increasingly more short, which creates a bit of an interesting issue to think about, longer term. Alexis, inflation, is it a high-class problem?
Yeah, well, I would agree that I'm much more focused on the downside from deflation. You and I were talking about this right at the beginning, Pierre. We said, I would say I was sharing with a client, I could see inflation in specific product categories like face masks, but I'm much more concerned about the deflation resulting from economic stops. Added to that, or underpinned by that, the demographic situation where I think you've just seen, the decline of the Phillips curve, just stagnant price environment here in the U.S. after the GFC, which, of course, as Abby highlighted, has issues insofar as companies can't regain pricing power over their consumers. So that has downside impact for raising wages, which, of course, for the bottom 90th percentile of the income distribution have been very paltry for the last 38 years. So that is an advanced economy. So I would say it's a rich country problem. I would say for some of the emerging market economies, currently, as Abby highlighted, if you look at headline inflation, you are seeing deflation in certain categories, namely in oil, and as food prices often move in concert and other commodity prices move in concert with the price of oil, making things slightly more affordable for net energy importers. But just thinking about tepid demand globally and thinking about the underlying drivers of economic growth for emerging economies, I think you're going to see significant headwinds just in terms of demand for exports in goods and services going forward, less of an activity in terms of global value chains, which we can come to. On the fiscal side of things, one positive thing you had thinking about the last crisis was for many emerging Asian economies was the Asian flu. One thing that you've seen significant evidence of is the imposition of macroprudential measures across the board, things like reducing the fiscal deficit, moving from a fixed to a floating exchange rate, and keeping things like foreign currency reserves on hand to be able to shore up the economy in the face of an external shock. So we've seen with the hit of the trade war and some of the geopolitical uncertainty for the U.S., some of the central banks be very nimble on their feet in responding to the external shock to activity. That I would say those will separate some of the EM problem children from those that win in the beauty pageant. In terms of those that have been responsible.
Alexis, sorry to interrupt, but could you tell us who the problem children are?
Problem children for me, I mean, unfortunately, are Argentina, Turkey, South Africa, but Argentina and Turkey, I think, are significant at this point. Obviously, looking at Argentina's ninth restructuring, what you saw in Turkey was a loss of central banking independence, which resulted in a run-up in inflation. So having gone from having one of the best central banks by all the ratings agencies to totally losing independence, I think is very severe. And in terms of the beauty pageant, the Philippines and Vietnam, incidentally, are also two economies that have been not as hard hit by the coronavirus. India is one that was on the cusp and I think was sliding into negative territory in terms of economic activity. And sort of, fiscal space moving into the coronavirus. And I think that's going to hurt India for some time.
Okay. There are questions about U.S.-China relations, and maybe I'll turn to you, Alexis, if you want to take a first stab at that. U.S.-China relations, and more broadly, global capital flows and global trade flows. Where do you see that going over the next few years?
I think what we've watched unfold in between Washington and Beijing since this outbreak has been extremely dire for global stability. As Abby was highlighting, a vacuum of U.S. leadership. The blame game that's going on, I think, has been, exacerbated to new heights. I think when you eject your foreign journalists, and many have said that's one step to ejecting your ambassadors. So I think the crisis couldn't be any more taut, and the tension couldn't be any more taut between Beijing and Washington. Also looking at some pensions dumping Chinese equities, I think we've had that throughout the trade war. A lot depends on the next election and in the U.S. and who takes the White House in January. In terms of that relationship going forward. When I speak with Chinese economists, I think what I note and looking at the PBOC is the overwhelming extent to which the government has been nimble in its response to the virus economically, and with stores of monetary policy and fiscal policy to be able to put to use. So I would say that some of the calls that China is going to implode are overblown. And what I would say is just an increase or an escalation in the technological decoupling, which was happening between the two countries with effectively two separate systems of global technology. That is something that's underway. It doesn't have any bearing on who is the next president, that specific dimension. And that's going to get more expensive for companies and trickier for investors going forward.
How do you advise your clients to deal with that uncertainty? They have global supply chains.
When I've been asked by some Asian clients, what do? We have one Chinese supplier, we have one US supplier. I said, do you want to do business with the US? Because that's the way that it's going at the moment. And as I mentioned, I think it's not just dependent upon this president. So it's just going to mean an increase in cost of capital. Some countries have been very nimble on their feet. Vietnam developed their own indigenous 5G network. To my knowledge, it's the only country to have done so. I think others are still held into question. Germany is an interesting economy to look at because so much of Germany's rich trading relationship with China is built on Chinese technology and German products. So Germany, could potentially net lose in this situation of this technological segregation. So I think other countries will be on the fence. Brazil is another country that's delayed its 5G auction as well. I think probably waiting to see what happens.
Abby, your thoughts on U.S.-China relations and
I think
globalization?
Alexis was very thorough. I would just add the following, and that is, in recent years, the Chinese have been very effective in terms of using things like the Bridge and Road Initiative to make inroads. I didn't mean that as a pun, but they've used it as initiatives to have investments in various countries around the world to be thought better of in various places around the world. I know it backfired in a few countries, but it was intended to be something that would both be concrete and also something that would be helpful sort of at the PR level. And the Chinese are doing something similar right now in this pandemic period, in which they're making a big show of providing equipment, both PPE and ventilators and so on, to various countries around the world. Never mind that some of that equipment is defective. There is nevertheless the photo op that the Chinese have with the political leadership of whatever country is receiving it. If we take a look at the data, so something like WHO, the United States contribution, which is now in some jeopardy and under review by the Trump administration, the US contribution is many multiples that of China. But you wouldn't know that from the way the PR game is playing out. And so the United States, which has often been dominant in providing this kind of assistance, providing the scientific and basic research background, and so on, basically is not really showing the usual leadership that we typically would see, in part because we're not doing a particularly good job, as I understand it, on the PR front. Even in instances where the United States is providing assistance, for whatever reason, perhaps we're not getting the kind of shout out that we might like in different countries.
Excellent. One question which has come in the Q&A is it possible that U.S. manufacturing and possibly U.S. manufacturing workers stand to gain from these trends in deglobalization? I don't know who wants to take that on. What do you think, Abby, Alexis? Who wants to attack that one?
Well, this whole question of resourcing or insourcing has certainly gotten a lot of attention. We've seen it most in terms of a lot of the medical supplies, where it becomes a question of national security, where we might like to keep some of those things here. We may see similar arguments made in terms of airplane parts and so on going forward. Whether our workers benefit, it's an open question. It depends upon what exactly it is we're bringing back and whether these are well-paid positions. You know, what's the comparative advantage for the United States making a paper gown versus importing it from someplace else under normal circumstances? That's one aspect of it. The other aspect of it has to do with whether we are paying the American worker in a way that is consistent with the way other American workers get paid. If these become low-end, low-quality, hourly positions without much in the way of benefits or nothing in the way of benefits, it's something that may not be all that helpful to the worker. I'm not addressing the national security aspect of some of these things that we're talking about. On the longer range, which is, I think, your bigger question, is it will depend upon the industry. In many cases, we have to start rebuilding things if we're going to do that. And we also have to think about it in the opposite direction. Point in fact, Smithfield, which has been in the news quite a bit because of the problems they've had with unfortunate numbers of cases of positive coronavirus testing in their plants. Smithfield was sold to a Chinese company a few years ago. So we have to recognize that something that is on American soil is not necessarily an American company.
Alexis?
I would just say that, thank you for the question. And I think another dimension of it is the cost of inputs. So you're not just looking at workers and the final product here, you're also looking at some of the capital goods that go into the finished product. And what we've seen with the escalation of the trade war in an industry like steel, and this has historically been the case, is that some U.S. steel companies could not qualify as being made in USA because of the way in which steel is fabricated, which is a fruit of complex global supply chains, not just reliant upon China, but also on emerging industries, steel industries in India, also looking to Brazil, Russia. And so I think that the complexity and the cost of inputs is one that's significant. So I don't see the U.S. totally localizing the production of all of the components that go into a value-added product. Potentially in the PPE space, as Abby highlighted, the French are saying the same thing about the pharmaceutical space. But as I push back to the French government, everyone does fight the last crisis. So if the next, global crisis is not as a result of a pandemic, which I highly doubt it will be, then I would say potentially this is a bit backward looking. So I think also you have to think about the dimensions of the consumer tax and the increased cost of goods. I think people and companies would probably be willing to pay more for the PPE side of things or critical medical equipment. It may not be the same for a T-shirt or a highlighter, for example.
Great. We have way more questions than we can get through. There is one interesting one. We've touched upon it, but we could go a little bit deeper. Which sectors or industries, if any, do you see not only holding strength throughout this, but possibly popping out in the recovery as the next big exciting thing? And the person who asked the question volunteered gaming and virtual reality. But beyond those, are there possibly others that you can think of?
Yeah, well, if it's gaming, then we're also going to need virtual counseling for people with gambling problems. Let me take a stab at it and say this falls into the category of things that will be accelerated by the pandemic. One, of course, is work from home. Who heard of Zoom a year ago? Many of us had, but it has now become such a well-known thing. And of course, the technology that's needed to support people who work from home. Maybe not such a good situation for people who own a lot of commercial real estate as the amount of space per worker goes down, but that's the cross balance. E-retailing is another category. Telemedicine, another category, very significant. We're also seeing, and I think this is very positive, renewed discussion about whether, as a nation, we are investing sufficiently in science. I believe very strongly that we have not been, particularly over the last decade or two. In terms of dollars, it's been going up. Federal spending has been flat or down, but companies have picked up some of that slack. But as a percentage of GDP, we're at a 60-year low in terms of the amount of money we are investing as a nation in science. And I think that is very unfortunate. At the same time, a handful of other countries, about 20 of them, have leapfrogged us because they believe that as part of their own national plan for growth, they need to invest more heavily in science and in training scientists. So I would hope that something that comes out of this is a renewed national commitment in the United States that we need to allocate more of our government spending to this category. And I also think that we're seeing that some industries and companies will step up their spending here. Sometimes those companies do it by themselves. Sometimes they do it in concert with leading universities and research institutes. And I'd like to see more of those cooperative efforts.
Alexis?
There's your silver lining, Abby. I would agree with Abby in terms of e-commerce and logistics. I mean, that's one space here that has been the hottest space for global retail investors and real estate investors. What's interesting to note is going into Corona crisis, only 10% of retail sales in the United States were online. So that leaves a huge runway for growth in terms of supporting that growth in e-commerce. And that is just going to explode. You had also seen a lot of fragmentation in the sector here in the U.S. and places like China. I think that fragmentation will be largely worked through as a result of increase in investments. Deliveries, in terms of the delivery services, particularly food deliveries, we all know that is old news in places like New York and across Asia. I think that's only going to grow even in places like Europe. I would agree with Abby on telemedicine. That was on my list for sure. I would also just think about the specific subsector of logistics in terms of last mile delivery and urban distribution centers. So I think a lot of the retail landscape in terms of real estate will be reimagined in the realm of social distancing, and that some will probably be able to look to drive revenues out of their shops and via last mile delivery centers rather than having it be a separate company in terms of a different e-commerce platform. So I would see more of that going forward. I think it's also going to be interesting to see how education might change. And thinking about a private equity company who's invested a lot in education, how people will make money from this, because obviously schools are, critically going to need to, Columbia included, going to need to be able to continue education in the face of some sort of stop, even in the next few quarters. And so I think it's going to be fascinating to watch the way in which that's transformed.
If I can add the following, clearly, let's call it distance learning or e-education has already been a big focus in China, where there are two very successful companies that have been providing after-school tutoring to students as they get ready for their entrance exams and so on. But there's a general point I'd like to make, and that is I expect we're going to be seeing a lot of industry consolidation across many different industries. And it will be a function of several things. Number one, unfortunately, the pandemic induced distress that some companies will experience because of the abrupt reduction in demand for their products and or services, or what it's doing to their balance sheets and so on. So this will be the short-term phenomenon that might lead to industry consolidation. And even if those companies are not taken over in terms of their operating assets by another company, the other companies that do survive will be a larger percentage of the total. And the second factor, I think, that may lead to consolidation in a number of industries is the cost involved in moving to online platforms. E-retailers that have been successful have spent an awful lot of money getting themselves positioned to do that. It's not just the consumer interface, but it's all of the logistics in their warehouses, their supply chains and so on that have to be revamped to do that. And just think about what this means in a whole host of other industries, the enormous expenditures. I'll give you one example. Just a few weeks before the pandemic, Columbia joined forces with Cornell. They are both the medical schools that are part of New York Presbyterian Hospital to expand their telehealth offerings. Cornell and the hospital had been on the platform for a while. Columbia took a while, and I hate to say what the amount of money involved was, but that system is up and running, and the total expenditures for all three institutions was absolutely huge. But these are institutions that have been very successful over the years. One of the few hospital systems in the United States that actually makes, I'll call it a profit. It's not a profit in the usual sense, but it's they have money left over at the end of the year for the next year. And you think about the enormous expenditures that will be required, not just in the private sector, which is the way investors tend to think about it, but also the public sector. Think, for example, about the failures in the unemployment systems in various states around the country because they just couldn't handle the volumes involved. So I think we will be embarking upon very significant expenditures, very significant costs. And this sort of consolidation creates an opportunity for those companies that know how to do this and know how to assist others, even in different industries, in terms of getting it done.
Wonderful. I always like to end meetings on a positive note, and what's certainly true is that crises are often times of where there's tremendous creativity and innovation that can be utilized going forward. The Great Depression was actually a period of significant innovation, and hopefully the current crisis is truly an opportunity to harness a lot of the digital technologies that we've been developing for years and implement them across our economy. We're out of time, and I would really like to thank Abby, Joseph Cohen, and Alexis Crow for taking time out of their busy day to be here with us at Columbia. Thank you so much, and have a wonderful day, and please stay safe and healthy. Thank you.